We have seen incredible bullishness when it comes to the markets, both U.S. stock markets, bond markets, as this chart on the Bloomberg shows. The summer, July, August has been pretty good. We're now seeing a little bit of a divergence. What is the 10-year yield telling you?
So I think it's really been important when you've looked at some of the key areas with the 10-year, when it came down from its peak of 3.5, that was basically 3 days before we started this most recent, let's say, bull market run. And now it's been slowly increasing from its low of about 2.7. Now it's just crossed above 3 today, and that was about 2 weeks ago. So it has been a pretty good indicator of the changes in direction. And so I think particularly today, closing above 3, that's definitely a signal that we're seeing a little more fear, definitely some risk off. And that's been mimicked in the U.S. stock market. I think as long as the 10-year yield is just heading straight up, and it has been, it's been closing, one day after another, the yield's been going up. I think you should expect stocks to be facing headwinds. We're not going to see big up days. You should be more cautious. Also, I still think you can use a lot of these days as potential buying opportunities for longer term, because I think no matter whether we're talking about slowing rates this year, slowing hikes, possibly rate decreases by next year, the market definitely, for many aspects or portions of the market, are more fairly valued.
And of course, all of this volatility and uncertainty as we head towards Jackson Hole, we don't know what Chair Powell will say. A lot of speculation that, Fed officials will remain hawkish. We got the messaging the last few days.
Yep.
I wonder, though, if we get the hawkish rhetoric, and they try to tame inflation, then you have recession on the other hand. Are we going to see an economic slowdown? You're still confident on the U.S. consumer. How does that play into what the macroeconomic situation is right now?
Right. So that's the challenge. And the sort of the interesting thing is, what the stock market does and what the economy does are often two different things, because the stock market is so forward looking. So even if we do end up in a recession, and certainly nothing like the 2008 financial crisis, just because the debt's completely different, I think the stock market will be able to recover much more quickly versus anything we've seen more recently. But it could be rather stagnant. It could be very slow. We're looking at 5% earnings growth over the next 4 quarters. That certainly might be even below inflation. That's pretty dismal. And so there's no reason for PEs or valuations to significantly expand until we have a clearer idea of when rates are really going to come down.
But it's interesting, Erin, because I think your strategy of staying away from apparel, but looking at things like Marriott Vacation, that does see that convergence of Wall Street and Main Street, right? Do you see that leisure theme of people choosing to put their money towards experiences, the post-pandemic reopening, to be continuing?
Yes, I think there's still a lot of demand with the U.S. consumer. While people are switching, let's say, on, Walmart obviously being a great example of switching to generic brands, moving away from high-end brands if you can get the same thing at a lower price. The vacations, the experiences, those are the type of things that people are still very much willing to spend. And as long as unemployment stays, let's say, below 5%, still a relatively healthy economy, those are the companies that still can grow. And so that's one of the areas that I feel safer. Also, another company I like is Lowe's. Spending on your home is another area that consumers tend to still spend on, even when there is inflationary pressure.
You mentioned valuation opportunities for the longer term. Do you see that rotation back into any kind of tech leadership as part of that?
So I do more so on the smaller and mid-cap side. They were hit a little harder the past week, and in general their valuations are much lower than some of the particularly the mega caps and the large cap growth names. And so those are the names when I'm focusing on growth. I just feel it's a safer risk bet when you're talking about valuation perspective, even though, yes, it's going to be a challenging period for them to grow, particularly as rates rise. But the valuations have been so beaten up. I mean, they're trading essentially at like a 30% discount. Aspen Technology is one of those names, for example, that I own. It's basically a technology company, mid-cap. for B2B.
Erin, as an asset manager, when you look at your clients who are investing for the long term, who really want to retire on these savings, on the money they make right now, there was a really interesting story in the Bloomberg last week about the retirement crisis here in the U.S. So because of the market turmoil that erased, $3 trillion from IRAs and 401ks, if there are people who actually even have those open, right? We are hearing from President Biden about student loans later this week. Given the volatility in some of the safest assets that we thought were pretty safe, how do you manage that for the future for really young people who want to accumulate wealth?
You know, I actually think that this particular downturn was helpful in reminding a lot of young investors that markets are volatile, that they do go up and down, and we can have extended periods, because it was feeling, in the prior year, a little bubblish, a little like 2000. I've been in this business for a long time, so I've gone through quite a few bull and bear markets. And there was a certain amount of overconfidence. And so this helps, it's certainly sad if people want to remain on the sidelines and just say, I'm going to park my money in cash, but just remembering that you need a discipline, you want to have an outlook of 10 plus years, and that bear markets don't last forever. But you do have to have a certain understanding that things can go down. And if you need that cash in a short amount of time, don't put it in something as volatile as stocks. And even in this case, as we've learned, not even bonds. So if you need the cash, keep it in cash, but otherwise, let your investments grow.